Right, so I'll keep it to about 15 minutes, and then that'll be the formal end of our presentation. But obviously, given the fact that there's no time restrictions, we'll continue to host questions as we move along. So just to summarize in one slide, the message that I'm communicating. Number one, not to forget kind of the key investment mantra and what we always follow, and that's to buy great businesses at good prices. And what we're seeing in this market crash is the fact that you can buy some excellent businesses at very good prices. The volatility will prevail. I think a lot of people are having FOMO at the moment. FOMO means fear of missing out. We've seen the market bounce back very sharply, but we are in uncharted territory, and we don't think that that's the end of the volatility. Certainly in the South African market yesterday, we still had some shares going up 15 to 20%. We think that offshore equity has bounced too much in the short term. But having said that, it's still left behind a lot of really good companies. And there is still great opportunity in specific shares. We would exercise caution at the moment, and there might well be opportunities over the course of the next few months to buy into shares at lower prices. And we think you can be patient. You don't have to be in too much of a hurry. Outside of South Africa, as Nolan explained, there's very little yield available outside of emerging markets. So basically, the only place to really get great returns is in the equity market. We think the rand is extremely undervalued. And for South African investors who invested in rands in offshore markets, the rand coming back is probably the biggest risk from an investment perspective. We think the local equity market is offering some excellent opportunities. It's been hard to bang the drum too hard on South African equities over the course of the last 5 years. We've been in a sideways trending market. And this is really the first time in 5 or 6 years where we can find great companies at exceptionally good prices that we think offer a lot of upside. Having said that, the local bond market, as Nolan pointed out, is offering CPI plus 6. And that's a great return that you can lock in at the moment. Then also just to take a step back and remember that this crisis will pass, like all others have. We're in the midst of it. It feels very uncomfortable. But decisions made now in the middle of this crisis can be the most profitable decisions in a decade. Also, just to make the point, and our presentations at the moment are changing day by day because markets are so volatile. The US earnings season is about to begin. That's US companies reporting their quarterly earnings. And the messages that they send out will be very important for the future direction of markets. The crisis only really consumed about 1/3 of that 3-month or quarterly period. So it's really about what companies are saying about the future and their prospect statement. And we'll be reporting back to our clients on a regular basis in terms of what that is revealing. So going back to what we were saying only a few months ago, at the beginning of 2020, I think it's important to have this context. The forward PE on the S&P, which is the chart on the left-hand side, if you go back to kind of January, February 2020, was looking pretty expensive. So we were saying that the market looked moderately overvalued, but growth prospects looked promising. So we were somewhat cautious on offshore assets, but for the year, still expected a low dollar return from global equities. And we felt on the S&P that our fair value of the S&P was in the region of 3,000 to 3,200. Now remember those numbers for the next slide. At the same time, on the right-hand side, the global GDP growth, the IMF forecasts, had the world cruising along quite nicely north of a 3% GDP growth number. At the moment, the forecasts for global GDP decline are anywhere between 3 and 6% for the quarter that we're heading into, and then coming out negative for the year. Significantly, if you look at January 2009, we only went slightly negative for that year. Right, so what's happened in 2020? We certainly didn't forecast the oil wars, and we didn't forecast that a gentleman eating a bat in Wuhan would create a global crisis and we'd all be sitting at home watching a webinar. So the chart on the left is the actual S&P index, and you can see at the beginning of the year, it got up to 3,400 and then plunged down to 2,400. So the American market from top to bottom had a 30% decline. However, much to everybody's surprise, it's retraced significantly I think we all expect ups and downs in bear markets, but the extent of it has been significant. So that's about 17% up from the bottom. And surprisingly, the S&P is now only down 12.5% for the year. In fact, after last night's rise, the S&P for the year is only now down 10%. Global markets are worse. The slides that Peter Little showed at the beginning indicated that the MSCI world, which includes all the economies around the world, is down quite a bit more. And that's largely because the US stimulus packages that have been put in place have resulted in the US being the best performing market. And the S&P P multiple on the right-hand side has come down to more reasonable levels. So we said earlier at the beginning of the year, we thought a fair value range for the S&P would be in the region of 3,000 to 3,200. We now think, based on fundamentals and with quite a bit of risk, that our fair value has decreased to 2,800 to 3,000. That doesn't mean it stays there, and it can deviate around that quite significantly. We think that earnings in US companies will decline for the next 12 to 18 months, and hence we've trimmed about 10% off our fair value estimate. But sectors themselves have behaved very differently. And it's quite dangerous at times like these just to look at index levels. Below the index levels, there's some shares and some sectors where there's very different behavior. So the opportunities, we think, lie in picking the right shares, and there's some really big bargains that still exist. We don't think it's a time for passive investing. This is really a time where active managers and active management and picking of shares can be significant. I think most importantly, and to emphasize that our favored global sector for the next 10 years is tech. It's about 25% of global market capitalization and certainly has the best growth prospects. But in this crisis, and here we've got a chart of Amazon, which you can see has hardly reacted. It went down and bounced back pretty quickly, but is now higher than it was at the beginning of the year. So a lot of the global tech giants have been great investments. We've had a lot of exposure to them. But on a relative value basis, and in trying to play the recovery, obviously there's much more upside in shares that have gone down than shares that have gone up. So let's have a look at different sectors of the market. There's quite a lot of detail in the slides that follow, and I'm going to try and go through them quite quickly. But we are very happy to send out these slides if people want to absorb them in more detail. So if you look at the different sectors of the market, with an S&P 500 portfolio at this stage down 22%, energy, financials, and cyclicals, much harder hit. So within this, we can go and identify specific shares. So in playing this recovery from a global equity perspective, we're certainly not changing and we're not urging people to get out of long-term high-quality growth portfolios. That should always remain the core of your portfolio. But we think it's an interesting opportunity to invest in recovery shares to supplement a long-term portfolio. Notably, the recovery portfolio has little technology, as we've explained. That's not where the opportunity lies in terms of what prices have done. And this portfolio also doesn't have typical portfolio construction characteristics. So after a market crash, the opportunity to buy durable, high-quality businesses at bargain prices is very appealing. But just to emphasize that this kind of share portfolio, in the short term can go anywhere, and the investor must be able to stomach volatility. Just a quick glance, this is our global high street equity portfolio that we've been running for 8 years, the top 10 holdings in the middle, and you can see quite a big weighting to technology and high quality shares around the world. So what we're suggesting now is something a little bit different. So this we think is an interesting way to approach the recovery. Again, I'm not going to go through in too much detail, but just to emphasize the three categories of shares that we're identifying. One is low risk shares that are not especially cheap, but have had a big correction. So these are businesses like your Starbucks and McDonald's, businesses that we're pretty comfortable in a year's time will be the same businesses they were 3 months ago. These companies are never cheap because they're high quality, but it's a good time to buy into them. In the medium risk category, we've got some companies, and here we focused on businesses that have got phenomenal track records. So for example, something like Leggett & Platt has increased its dividends for 49 years in a row. So these are durable, great, and typically US industrial businesses. And the story really here is that you're buying them on 8 or 9 PE multiples. whereas over time they tend to trade at 15 to 16 PE multiples. Then for those who are feeling very brave, we've identified some higher risk shares that appear very, very uncomfortable to buy, but we think will survive the crisis. So things there like Boeing and Beacon Roofing, Delta Airlines. We would have very small weightings to these because obviously the risks are pretty high. So to quickly flip through a few of the selected shares, and again, I'm not going to go through the slide in massive detail, but Starbucks, we think in everyday luxury will come back. We think in 12 months' time, people will be spending as much on Starbucks as they did 3 months ago. So we think that's a nice opportunity for investors. Stryker is a share that we've recently bought into our high-quality portfolio. You can see the price graph on the right-hand side, how it fell off a cliff. And the small chart at the top is the history of net sales growth. So this is one of the world's leaders in joint implant and replacement, so knees, hips, spine, etc. And demand for that will just continue to grow over time as the population ages. So turnover will be hit over the course of the next 6 months. But if you need a knee replacement, it's merely a deferral as opposed to cancelling what you want to do. So at a 30% discount, we think that's a nice opportunity. Cisco is a very similar company to Bidcorp. It's South Africa. It's the US's biggest food distributor. So it supplies into restaurants, hotels, government, prisons, hospitals, etc. Its business will obviously be hit very hard, but we think for quite a short time period, and we think this will come back. So this company's tended to trade at about a 22p multiple over time, a very high quality business with great cash flows, and it's basically halved, and you can buy it at an 11 PE. We think it's got the balance sheet to survive what we're going through at the moment, and it's a nice entry point. Then shares that are very uncomfortable to buy, and most people aren't even talking about them. And for those with a stomach for risk, something like Boeing, we think is a really interesting one. So you can see the share price on the right-hand side. It peaked at nearly 450 Rand and is now trading kind of between the 100 and 150. So Boeing's problems were exacerbated by the grounding of the 737 MAX aircraft, and that will get resolved. But they now go into a period where their turnover levels could be extremely low for 12 to 24 months. But if you look further out, basically people do need to still buy aeroplanes. Aeroplanes age, and there's two major manufacturers around the world in terms of Airbus and Boeing. So this business is not going away. It's currently, after the fall, got a market capitalization of $70 billion, which is over R1 trillion. It employs 160,000 people. And importantly, it went into this crisis with very low debt levels, 0.5 times debt to normalized EBITDA. So the company is going to have some tough times, but you're buying it at a third of what you paid at a point in time over the course of the last 2 years, and an interesting value add. Then quickly on the South African market, we're putting out lots of material in this, and the guys in the business can share ideas with you. We do that on our daily newsletter and to clients. So in South African incorporated shares, we've experienced a crash after a crash. A lot of companies were really battling and hadn't gone anywhere for quite some time. The shares were already cheap, and this was followed by the COVID crash that we've experienced. So we'd be avoiding high-risk places for now. I think what we're saying to a lot of people about shares that are high risk is you don't need to be taking high risk and balance sheet risk to get a return. There's a lot of good businesses without big debt issues that can bounce back quite nicely. And we think there's trading opportunities around for the first time in years. So some of our clients are making a lot of money trading the market more actively. And for people who've got an appetite to do that, we're certainly happy to guide them along the way. Some specific opportunities, and this list is kind of changing every week because share prices are bouncing all around town. But 5 shares that we're putting up here today. One is MTN. MTN, we value the South African business at about 60 Rand a share, and it's trading below that. Nigeria is obviously quite problematic with the oil price, but we think that will resolve itself in time. So we're not wild about the business. It's going to go through some tough times, but from a valuation point of view, looking very, very cheap. Bidcorp is one of the highest quality companies in the South African market. It's about 15% South African. It's got operations all around the world. big in the UK and the US, and it's a similar story to Cisco. It's food distribution, and food distribution will return, but you can buy the share now at a significant discount. A business like ShopRite, which is a great quality long-term business, and we've owned it for a lot of the time in our client portfolios. You used to have to pay close to 300 Rand for that share. It's now trading at around the 120 Rand level. Bidvest is a high-quality play on the bounce back of the South African economy. Just to be clear, as Nolan indicated, we're not wildly excited about the SA economy. It's going to come under a lot of pressure, but Bidvest is very well diversified. And then quite an interesting one, Alviva, which was the old Pinnacle. It's a small cap. We've added it in for a bit of flavor. But to put that in context, that company made 450 million Rand after tax last year, and the value of the business on the market is now 650 million Rand. We met and talked with management recently. The business will do all right. Obviously volumes down significantly. They had a big boom before lockdown, where they sold, I think, virtually every PC and laptop that they had available because people had to work from home. But that business, we think, is fundamentally worth around 15 Rand and trading at around the 6 Rand level. So that's the summary of what we wanted to talk about. I guess just to go through in summary, the markets offshore have bounced back quite sharply. We don't think the bounce back is fully warranted. We expect volatility to continue. But within that, if you look at a level deeper, there's certainly some very exciting shares and great quality businesses who've endured 2008, who've endured other crashes, who've endured 1999, and will come back strongly. And a lot of those you can buy at 20 to 50% discounts. The bond market is looking interesting. The South African market is trading at valuations that we haven't seen, probably in a decade. A lot of companies are trading at prices that they were back in 2009, 2010.